The global economy will crash.
This essentially guarantees a very, very deep global recession.
Facing a real shock that is probably beyond what we can imagine at the moment.
Now, that might sound like a bold statement, but history has a habit of repeating itself, and I've been around long enough to see what happens when things start going wrong. And right now, debt and oil prices are rising, consumer spending is slowing, all at the same time. When it comes to something as big as the global economy, it doesn't just fall apart overnight. It starts with small cracks and subtle warning signs that most people either miss or choose to completely ignore. Even Larry Fink, the CEO of BlackRock, is publicly warning about a potential recession. And to be honest, I share those concerns. So let's break this down step by step, because what's happening right now follows a very predictable pattern. And if you understand that pattern early, you don't just avoid losing money, but actually position yourself to make it. So let's start with where it all begins, the triggers. Financial crises don't just appear out of nowhere. They're triggered by pressure building outside the system until it finally explodes. And right now, that pressure is building very quickly, which could lead to an economic downturn that hits us right where it hurts. If we zoom out and take a look at the financial crisis of 2008, you'd probably think it all started when the stock market crashed. But it actually started years earlier with cheap money, rising debt, and pressure building in the background while everything looked fine on the surface. And if you look back even further, every major downturn has started the same way, not with panic, but with pressure. The biggest driver of that pressure right now is energy, and more specifically, oil. Because over the past few weeks, the situation between the US and Iran has escalated into a full-blown conflict.
A short time ago, the United States military began major combat operations in Iran.
And it's directly hitting one of the most important choke points in the world, the Strait of Hormuz. This single stretch of water normally carries around 20% of the world's oil supply, and right now it's effectively been shut down, which means tankers are stuck, shipping has collapsed, and a huge chunk of the global supply has been taken off the market. I've seen this happen so many times before, like in 1990 during the Gulf War, in 2008 just before the financial crisis, and in 2022 when supply shocks sent prices flying. What this shows is that when you suddenly remove that much oil from the system, prices don't just rise gently, they spike. I mean, we've already seen oil prices push well above $100 a barrel, with the global benchmark pushing towards $115, compared to the usual $70 to $80. And analysts are warning it could go much higher if the conflict continues. I actually just got back from putting fuel in my car. I didn't particularly need it as I already had around half a tank, but as I was there, I thought I'd fill it anyway. And that half tank cost me the same amount as a full tank cost me not so long ago. Don't quote me on that, but that's what it felt like. Now, Trump seems pretty confident he's going to be able to get this issue resolved sooner rather than later. And hopefully he's right, because oil isn't just another commodity like gold or silver, because it has a direct impact on our everyday lives and the stock market. Remember earlier when I said history repeats itself? Well, if we look back at the last three major oil supply shocks, 1990, 2008 and 2022, every single time oil prices surged well above their normal levels, the S&P 500 fell significantly. And every time oil came back down below that level, the stock market recovered. It's pretty crazy, and most people don't realise the effect oil has on the stock market. But this doesn't just impact your investment portfolio, because oil is the fuel that our lives literally rely on, like for transportation of goods, the production of food, and even power generation for large parts of the world. So when oil prices surge like this, it pushes up the cost of everything at the same time, and that feeds directly into the second trigger, which is inflation. Now, inflation was supposed to be coming down, as the Federal Reserve has spent the last few years aggressively raising interest rates to get it under control. And for a moment, it looked like it was working, because when the rates are high, borrowing becomes more expensive, which naturally slows consumer and business spending. The idea is that if people spend less, businesses will be forced to stop raising prices and potentially even lower them, which drives down inflation. But now we've got a fresh shock coming into the system, not from people spending too much, but from lack of supply. Energy prices are rising, supply chains are tightening, and production costs are increasing, which is very dangerous. because central banks can't easily fix that. They can raise interest rates, sure, but they can't just produce more oil. So instead of solving the problem, they end up putting even more pressure on the system. And that's where the next trigger comes in: debt. Because right now, the entire system is built on it. The US government alone is sitting on over $39 trillion in debt, running on a near $2 trillion deficit, and is now paying significantly more just to service that debt as interest rates stay high. And it's not just the government feeling this, because corporations are in a pretty similar position, because over the last decade, they loaded up on cheap borrowing when rates were near zero, and now a lot of that debt is being refinanced at much higher interest rates. So debt is getting more expensive, right as everything else is getting more expensive too. And if you add in some geopolitical tension as a multiplier, this isn't just one isolated issue. If there's one thing my many years in business and investing has taught me, it's that markets don't like uncertainty. Businesses don't invest in uncertainty, and supply chains don't function properly during uncertainty. So if we step back and look at the bigger picture, we've got a major energy shock removing a huge chunk of global supply, pushing up costs across the entire economy, which is driving inflation back up and forcing interest rates to stay higher for longer, all while the system is already overloaded with debt. And if that sounds familiar, it should, because this is exactly how these crises have played out before. The details and the headlines change as the causes are slightly different, but it's always pressure building in the background that most people ignore until suddenly everything starts to move at once. Up until now, everything we've talked about can sound a bit distant. I mean, oil prices, inflation, geopolitics. It all feels like something happening somewhere else in the world of boring economics. But this is the point where it stops being theory and starts becoming real life. Because once that pressure moves through the system, it doesn't hit governments first, it hits you. And it usually starts with interest rates. Normally when the economy starts looking shaky, people expect the Federal Reserve to step in and cut interest rates to give everyone a bit of breathing room. Like in 2001 during the dot-com bubble, the 2008 financial meltdown, and the global pandemic of 2020. Interest rates get slashed to near zero, which encourages spending and boosts the overall economy. It's often referred to as cheap money, and it's one of the reasons the stock market recovered so quickly during 2020, and a lot of businesses managed to thrive. But that's not what's happening right now. In fact, the Fed has just announced they're holding rates at between 3.5 and 3.75%. They're predicting higher inflation and still only see one cut this year. The reason for this goes right back to what we just talked about. Energy prices are rising again, inflation isn't fully under control, and central banks don't have the freedom to ease things like they normally would. So instead of relieving pressure, they're holding it in the system. And this is where people really start to feel the squeeze. Because high interest rates don't just live on some spreadsheet in Washington, they show up in the most personal places imaginable. Buying your first home suddenly feels out of reach. Mortgage payments jump for low-income families already on the breadline. Credit card debt becomes more expensive to carry, and financing a car goes from manageable to the worst decision you'll ever make. Essentially, borrowing money starts to feel a lot like a punishment. And when you combine that with the persistent cost of living crisis, the squeeze on regular people starts to get even tighter. This is especially true when it comes to the recent oil spikes, because the problems don't just stay neatly contained in the oil market. They work their way into delivery costs, utility bills, food prices, and pretty much every product that needs to be moved, packaged, refrigerated, or manufactured. Since the conflict with Iran escalated, national average gas prices in the US have jumped a hell of a lot, first rising above $3.50 a gallon earlier this month, then pushing up to roughly $3.98. And in some states, prices have already gone above $5. The government is clearly worried about this because the Trump administration has already moved to temporarily ease summer gasoline rules in an attempt to bring pump prices down. The idea is that this will make gas cheaper by not forcing retailers to switch to the more costly summer blend of fuel. Trump's doing this because he knows once petrol gets more expensive, people don't just magically absorb the cost. They have to cut something else, like driving less, hardly eating out, delaying a big purchase, or even just slapping the rest on a credit card and kicking the problem down the road. And that's the squeeze. Not one giant dramatic collapse all at once, but millions of people slowly adjusting their lives downwards at the exact same time. Now, I can't control oil prices or interest rates, and neither can you. But what you can control is how much money's coming in. And that's exactly why I'm teaching you the fastest path to making $10,000 per month online without needing startup capital or business experience in a free live online event very soon. So if you're serious about increasing your income, make sure to sign up to that. I'll leave a link in the description. At this stage, all of the things that have been building in the background start showing up in the one place you never want to see them, your money. Because the markets don't exactly create problems, and instead they reflect them. A lot of people look at the stock market like it's some separate game for the rich people in suits, but that's really not the case. The stock market is basically a giant forward-looking machine, and it's constantly trying to price what comes next. So when investors start seeing higher oil prices, stubborn inflation, weaker consumer spending, and a softer job market all at the same time, they don't wait for the economy to officially break and start reacting early. And that's exactly what we're seeing right now. The Dow has officially entered correction territory, down around 10% from its February high. The Nasdaq is following suit, and the S&P 500 is sitting at roughly 9% below its January record high. So if you've noticed a dip in your portfolio lately, it's important to know that this is happening for a reason. It's real people reacting to a very specific fear, which is that external pressure we've been talking about bleeding into the real economy. Now, I know some of you might be thinking, Mark, I'm not even investing in the stock market, so why should I care? And to be honest, that's a good question. But you see, when stocks fall, confidence falls, because when people feel less wealthy, they get more cautious and start second guessing every spending decision. When consumers start to spend less money, companies start to behave in a similar way. And that's another crack, because businesses always talk tough, right until the moment they start protecting themselves. And when uncertainty rises, the first thing they usually do is slow down on hiring, pull back on expansion, and get much more defensive about costs. There's a report called the S&P Global PMI, and it sounds complicated, but all it really does is survey companies and ask simple questions like, how are things going? Are you growing, hiring, getting more customers? And the latest numbers just came in at 51.4, which technically means the economy is still growing, but only just. It's actually the slowest pace we've seen in almost a year, but the real red flag isn't the number itself. It's what's underneath it. Because for the first time in over a year, private sector employment has actually started to contract, and that's important because businesses don't just randomly stop hiring. Companies are seeing weaker demand, higher costs, and more uncertainty, so they're starting to protect themselves at the expense of the livelihoods of everyday people. And that's how these situations develop. First, markets get volatile. Then businesses get cautious, which leads to slower hiring and even slower spending. Once that cycle starts feeding on itself, it becomes very hard to stop and could lead to the sharp decline of the overall economy. Well, at this point, you've really only got two choices. You can react the way most people do, or you can respond the way experienced investors do. Because when things start getting uncertain like this, most people don't think clearly and start to panic. They see markets falling, headlines getting worse, prices going up, and their first instinct is to protect themselves. So they stop investing, sell at the wrong time, and sit on their cash waiting for things to feel safe again. But by the time things feel safe again, the opportunity is usually gone because markets don't wait for you to feel comfortable. They move first and recover before most people even realize what's happening. I've seen this play out over and over again and spoken about it before on my main channel. The people who build real wealth during these periods aren't the ones reacting emotionally. They're the ones preparing while everyone else is distracted. Look, I'm not a financial advisor, but I am an experienced investor who survived market crashes, global recessions, and everything in between. And I can tell you confidently that the people who profit from this crisis will be doing four things that feel hard in the moment, but pay off massively long term. First, they'll be building an online side hustle to take control of their income, not worry about large corporations laying off workers. Second, they'll be keeping cash ready, not out of fear, but for flexibility. Third, they'll stay invested in the market because they understand that timing it is almost impossible. And fourth, they look for opportunities. Because when everything gets squeezed and markets pull back, assets get mispriced and good companies get dragged down with the bad ones. And that's when the golden opportunities start to appear. I hope you found this video useful. Make sure to check out the video I'm leaving right up there and feel free to subscribe and leave a comment. I always read as many as I can.